So when I first started investing in stocks and also trading stocks, I really looked at more about the technical nature of stocks. And I'm not saying technical analysis is not important, and it's very important when determining various prices to purchase shares at. But what I've learned over the last couple of years, especially in the current market conditions where the whole market is selling off, it's more important to understand the fundamentals of a company to ensure it can withstand these strong or harsh economic times that we're going in. And that's what we're going to go through in this video. We're going to go through my very own 5-step process on how to analyze a stock. And I've designed it in such a way that you can analyze a stock in under 30 seconds, and you can do it absolutely free with this one website that I will show with you and share inside the description. So if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe. So before we begin, the first thing, classic quote from Warren Buffett, is the first rule of investing is don't lose money, and the second rule of investing is don't forget the first rule. This is so important here. This 5-step process that I've created is based on some of the legendary investors like Warren Buffett, on making sure that when we put money into an individual stock, that we are making sure that over the long term that we will not lose money. Yes, it's all about growth and getting an appreciation, all those different things, but the key here is not to lose money. And the good thing is I've taken this one step further by utilizing what Warren Buffett's trading strategy, utilizing options. So we'll go through 3 stocks and we'll put it through the 5-step process, and one of the stocks we'll look at that does hit the 5-step criteria. We will then look at how I would personally go in to go buy this stock. So, and how you can make income throughout while you're waiting to buy the stock. It may sound too good to be true, but stay to the end and you'll work out how to do it. So, the 5-step process is as follows. Step 1 is understand what the company does. Now, this might sound very basic, but I have invested in stocks, growth stocks where, yes, okay, I can read the company description and I kind of understand it, but what products do they sell? What services do they sell? How do they make their money? Right? Who are their clients? Who are their consumers? Are they a B2B business or are they a B2C? Are they both? Just understanding that information is kind of there. So, if there's a stock that you like, or you like the price of, or it hits the other 2 to 5 criterias, look at their website, look at their 10K, look at all of the information so you can understand and get a feel of what that company does, right? And I can't stress that enough, because if you invest in that company and that company starts going down and you don't believe in what that company does and what that company stands for, you might then start exiting your position a lot earlier than you probably should be. The second piece is revenue growth. Their top line sales need to be growing over the last 5 years. We need to see growth, right? Net income growth. So you got your revenue growth minus all the costs. Are they actually profitable? Is their profitability growing over the past 5 years? The next one is positive free cash flow growth over the last 5 years. And what free cash flow is, it is the free cash that is left after operating expenses and capital expenditure has been paid. So how much free cash have they got available to grow their business, for acquisitions, to buy back shares, to give out dividends, all these things. We want that free cash flow number growing as big as we possibly can. And Warren Buffett um, believes that line, the positive free cash flow, is probably one of the most important things when he goes and invests inside a company. And then once you've done steps 1 to 4, and you've got to tick boxes in 1 to 4, what we need to do is understand where the share price currently is versus its intrinsic value. So an intrinsic value is if you sold off all the assets of the company, what is the value that's left of the company against all the shares that it's got outstanding. And there are many different criteria and models to be able to value a company, and the one we'll be using is a free cash flow model because it's what Warren Buffett uses. So we might as well not reinvent the wheel and use a free cash flow model as well. And again, there's a website that allows you to do this for absolutely free. And so just to kind of give you a visual view of intrinsic value, what you'll see over here is this is the value of the stock. The stock over time will go up in value, and this is time. The share price will go up and down, up and down. Stocks don't go in a straight line. They go in waves. And what we're looking for is times where, if this black line is the intrinsic value of a company, we want to try to be buying, picking up shares of this company at this level, and potentially buy less of a position at this level, or sell the stock at this level if there's a better opportunity to place that money. So that's what we're trying to do, and that's what we're going to work out inside the next slide. So we're going to go through 3 stock examples now. The first one is the classic Apple, right? So Apple is down 19% year to date in 2022. Now, a lot of people think that, okay, Apple's down 19%, so it must be cheap, it must be better value, right? But what we're going to do, we're going to put it through its paces, and to see, is Apple at its intrinsic value? Where is Apple? Is it here, or is it here? That's what we need to work out. So the first thing, if we go through the steps, now the website that I use to work out the steps, again, the link will be down below, is gurufocus. Gurufocus is a financial data provider for stocks. Got a huge amount of information that it gives you for free. They do have a paid version. I'm not affiliated with it. I've got a free account. And what you want to look for is the DCF, which is the discounted cash flow section of a stock. So if you type in Apple DCF, gurufocus will probably be the first link inside there. And again, you can view the page and view the screen that I'm sharing now absolutely free. And I'll link to it down below for the 3 stocks that I'm going to go through. And the reason why I like it gives you everything on the one page. I wanted to keep this simple for you guys. I didn't want you to go to like Yahoo Finance, Google Finance, gurufocus. I wanted to try keep everything together as best I can. So if we look at step 1, do we understand what Apple does? I'm not going to go through that. I think that's quite self-explanatory. The next thing we want to do is their revenue growth. Have they seen revenue growth over the last 5 years? So over here you've got revenue, and we're looking at the 5-year column. So in the last 5 years, their annual growth rate has been 15.7%. Tick box there. Has their net income, or otherwise known as operating income, up over the last 5 years, which it is 15.5. And then you've got EBITDA. We're not going to get into, don't need to really worry about that. As long as you've got revenue and operating income, EBITDA will also be positive, more than likely. Then we've got free cash flow is also up 17.6%. So check 1, we understand what they do. Revenue up, operating income up, free cash flow up. So we've got 4 things that were there. Now the question becomes is the current price, as time of recording, 143.78, the right price to be paying for Apple? Now, the way we do this on this calculator is you firstly make sure you have highlighted free cash flow. Again, you can also do another valuation model is EPS, which is earnings per share, but again, we'll be using the free cash flow method. And what it does, when you click this, it will give you the TTM value of the free cash flow, which is trailing 12 months. So in the last 12 months, their free cash flow is $6.39 per share, and it does this automatically for you. The next thing what we need to understand is the, we'll go to the discount rate after, is the growth rate. So over the next 10 years, what is the growth rate of Apple's free cash flow? Now, you can see here in the last 10 years, their free cash flow has been 13.9%. Now I've gone with 8% because Apple is a beast of a company. They need to slow down. Their growth rate is going to slow down over the coming years. And again, you can play around with these numbers. I've looked at analyst estimates on Yahoo Finance and kind of got a gauge of around, they had it about 9-10%, whereas I've lowered it slightly to 8%. So in the growth stage, over the next 10 years, I expect their free cash flow to grow at 8%, which is lower than the current growth rate currently. Then you have the terminal stage, which is, after the growth cycle, even though you could probably argue that Apple is starting to get in their terminal stage. And I've done this, at 4%, which is, well, the rate of inflation has gone up, but, normally at 3-4% the rate of inflation, right? So over the next 20 years, we've got 8% in the first 10 and 4% in the next 10, and the same logic will follow over the next two stocks. So I won't spend that long going on to that. So that's the growth in terminal. Then we've got your discount rate. So what it does then is it tries to work out the net present value, which basically means is it will calculate what the free cash flow percentage is going to be after year 20, effectively taking into account the growth and the terminal, and it will discount it back by 9%. Now I've chosen 9% just as an example because that's the default. You can increase this or decrease this depending on your liking. Bear in mind that you can probably make 9% just investing in the S&P 500 over the long term. Apologies. So you might want to increase that slightly, but I've left it at 9 just to show you the example on this. So once you've done all of that, and again, it's very easy, you can do this within seconds. You'll see here that the fair value of Apple, or the intrinsic value of Apple, is $106.18, which is 35% away from the current price of 143.78. So therefore, in this term, Apple is actually considered still to be overvalued. So if we look back at this slide over here, it's around this level over here roughly, because it needs to drop to that level. So even though Apple has dropped by 19% year to date, which is a lot, and people are starting to say Apple is cheap, which it might be. Again, intrinsic value is very subjective, right? Based on the numbers that you put in. If you think it's going to grow by 10%, this fair value will go up, right? Because you're expecting higher growth. So again, I like to put conservative numbers in there, and I need to be patient here. So I don't own any Apple stock currently. I am being patient and waiting for Apple to get to this price. It may not get to 106.18, and I have to be okay with that, right? Because there's thousands of stocks to choose from. If I miss out on Apple, so be it, right? So that's where the discipline comes in, is not to get hasty and to make sure you get into Apple at a fair price. Whereas I don't even want to get in at 106, right? Because I want to get in here. 106 is this line. I want to get in around this area over here. So 106 is not even the right level. I want to get in like a below 100. And again, people will say, "Oh, Apple will never get below 100." Did people expect Apple to go to 143? So it's still got a bit to go, but these things can happen. So Apple for me is something that's on my watch list, and I'm waiting for it to get to that price. The next example is Tesla. Tesla is a different type of beast, or an example. It's more still a very early stage growth company. Tesla is down 33% year to date. And what's interesting, you can see here, if you go through the checklist, right, do we understand what Tesla does? Yes, we do. Revenue growth over the last 5 years, 33% over the last 5 years, bang. But if you look at operating income and free cash flow, they don't have it, which means that they were a non-profitable company within the last 5 years, and they didn't have any free cash flow, negative free cash flow. But you can see here that they've are now starting to become profitable at 327 and 183% of free cash flow. So over the coming years, we will start having these 5-10 year population numbers because they are currently profitable today. So It does not hit the 5-step process. However, because the company is currently profitable, we can still do a fair value analysis or an intrinsic value analysis. So firstly, I wouldn't even consider investing in Tesla. And again, people might not like that. People might think Tesla is cheap and all these other different things. But again, not mine, but Warren Buffett's number one rule of investing is don't lose money, right? And don't lose money. What's the point risking putting your money into Tesla when there's other stocks? And the next example I'll show you, where I think is an even better place to be investing. So if you look at their trailing 12 months, free cash flow is 610 or 6.096, discount rate at 9%. What I've done here is I've done a 5-year growth stage, and I've done 40% because I don't have any 10-year numbers, and and I only can see analyst estimates, and I think analyst estimates was at 39.8%, so I've rounded up to 40, and the terminal stage I've put it at 20%. Again, these are numbers that I've plucked out of thin air, and I don't have access to analyst estimates or paid for services to give me that information, but I think they're probably conservative, right? And even at a conservative stage, it's spitting out here that the fair value of Tesla is $444 with a current stock price of 700. So even if it did have populated numbers here, at these numbers here, and this estimate numbers, we are still not at fair value. So again, Tesla for me is one that I personally think it will still come down considerably, and my view here is to be waiting. It might be 2-3 years before I get into Tesla, as we get more and more numbers. So it's not one that I'm particularly looking at the moment based on the numbers that I'm seeing. So hopefully this starts to make a little bit of sense of the analysis that I'm going through to say yes or no to a stock. And then the third example is Meta platform. So Facebook, ticker symbol FB. That's down 43% year to date. This is a beast of a company, right? Last 5-year revenue growth, 32%. Net income, 26% growth year over year. Free cash flow, 23%. It has got a lot of cash. It's a cash machine. And so if we look at, so it's got tick boxes across all of those. Free cash flow, $14 per share, trading 12 months. So the next 10 years, I've gone with a conservative growth rate, right? Last 10 years, they did 45. Again, we're not even talking about the metaverse at the moment, right? I think that's not even priced into this 15% growth rate. And then I've gone with a 10-year outlook after that of 4%, which, again, I still think is very low. But even with those numbers, right, the current stock price is $191. The fair value, according to these numbers, is $379. That's near 50% difference between where we are currently today, right? At these numbers, and with my analysis and what I think of the growth rates or what I think Facebook can become or Meta can become, this is a steal, right? So for me personally, I've not been buying shares. What I've been doing is selling puts. So I'm going to walk you guys through what I'm personally doing with Meta. I don't own any shares, but I'm making about $300 to $500 a month while I'm waiting for Meta to come to the price that I want to pay for it. And the way I do that is through options, right? So I sell options, and I've got a number of videos which I'll link to down below in the top right corner of how I make monthly income selling options on stocks that I want to own and on stocks that I do already own. And what I do, firstly, if I don't own any shares in a company, but a company I want to buy, I then sell put options. And selling a put option is basically saying is I'm willing to buy a minimum of 100 shares. So to sell options, they come in blocks of 100. So I'm willing to buy 100 shares of Meta at a strike price of X at a date of Y, right? So we know that the fair value is at 379, so I'm comfortable with where it is. So we are completely undervalued at the moment, in my personal opinion. The stock price is 191. So what I've been doing, I've been selling puts. Sorry, I've been selling puts at a strike price of 180. So I'm saying I'm willing to buy Meta Platforms at $180 by June 24th, which is about 28 days from today's date of recording. And you know the buyer of this option will pay me anywhere between $505 to $525 for selling them this option. So even if we take the bid price of $505, if I place this option, I would make $505, and the collateral I would need is 100 shares of Facebook at $180 per share, which is $18,000, which is 2.8% return on my money, right? For shares that I wouldn't mind owning at 190, right? So think about this for a second, right? By June 24th, if Facebook is at 180 or below, I will own 100 shares of Facebook at 180, but I'll also have $505 extra money in my pocket. If Facebook closes at $200, for example, right, by June 24th, or stays at 190, 163, I get my $18,000 back, and I keep $505, right? So I make 2.8% return on my money, whatever happens. Worst case scenario, I don't even think it's the worst case scenario, is I pick up 100 shares of Meta at 180 and the price drops to 170. But I'm willing to buy the shares today at 191. So I would just be holding the shares anyway. So hopefully you can start to see the power of this. And this is what Warren Buffett does with things like Coke, right? At bigger numbers than what I'm talking about here. But he loves Coke. He says, I'm willing to buy Coke. I don't know what Coke is. I think it's around $50, $60 at 40, right? In a year's time. And that you won't pick up much premium, but he's doing like millions of dollars inside it. So, he's making a fair chunk of change. And he'll buy Coke all day long at $40, right? Or whatever it is. So this is how you supercharge your strategy. If you follow this 5-step process, you will buy high quality companies or find high quality companies, analyze high quality companies, and then again, if you don't have 18,000 to start buying shares into and you want to invest $100 a month or whatever, then do that. Start picking up some shares and work your way up to 100, because once you have 100 shares of a stock, you can start selling covered calls, and that will again supercharge and start giving you income. Different video, got loads of that. I'll link to that as well. But that is basically the 5-step process that to go for. Understand what they do: revenue growth, net income growth, free cash flow, share price below intrinsic value. Use the gurufocus DCF calculator to give you the answer to all that question within 30 seconds. So hopefully you find that useful. I've got some analysis videos on intrinsic value stocks, which is on the screen now. Click on those, and I shall see you guys in the next video.